Hello and welcome to MK Econ. This video looks at income elasticity of demand. It's the second of the 4 types of elasticity taught on most economics courses. Have a look at the other videos I've done on the other 3. Income elasticity of demand can be abbreviated to YED. So Y stands for income for economists, I was used for investment. YED measures how responsive quantity demanded is to a change in income. Firms do use it to help decide which goods they should make more or less of, depending on economic forecasts. And we'll see that in a question at the end of these slides. Governments can also use it to see the expected impact of changes in income on consumer behaviour and impacts on things like government tax revenue receipts. So let's practice the quantitative skills with some YED calculation theory. So the formula for calculating YED is percentage change in quantity demanded divided by percentage change in income. And you can see I've used abbreviations here of the triangle for change, QD for quantity demanded, and Y for income. You can write it in full, but this would save you time. It's important that you include all those symbols and in that exact order, otherwise it means something slightly different. And also you should double check that you've definitely put a Y on the bottom of this formula. One of the common errors with YED is that you've already probably learnt PED, and without realising you have a default setting of always putting P on the bottom of that formula or writing price instead of income. Include the formula in your workings. There's a possible mark there, but the main reason for having it is to double check for yourself that you've definitely plugged in the numbers correctly to top and bottom. You've definitely put in quantity demand at the top of the formula and income at the bottom. So have it there as a double check more than anything. And because it's so important to remember the way round that you put the quantity demanded and income, I have a silly memory aid, which I did warn you if you'd watched the PED video is going to get more ridiculous. And here it's Quacky Duck sits on a yacht. So the Q and the D from quantity demanded at the top of the formula goes to Quacky Duck, and I've lost the price, so I had to change it to yacht for the bottom. See if you can do better. Now, this is fairly straightforward maths. We've got 2 percentage changes in this formula, but let's just have a little look at one possible way how you might calculate that, because it might be a while since you've actually learnt this. So my memory aid, and if you've got a better way or a different way that works, absolutely fine, stick with that. But here is one method of change divided by original times 100. And the number that you calculate is the YED coefficient. Now for YED, it can be different signs. So it could be positive or negative, and it will mean different things. We'll come to that in a moment. Before we leave this, just a few other points. Make sure you don't include the percent sign at the end of the coefficient. It's basically being cancelled out through your workings. Do write the number as a decimal, don't leave it as a fraction. And make sure you include your workings. That's for safety in case you make any errors later on, and also because it's easier for you to check you've done the right thing working through. Just make your final answer really clear, maybe underline it. So once you've calculated your YED number coefficient, there are various things you can deduce from both the sign, so whether it's positive or negative, and the size of the number. Let's start with the sign. So if you have a positive number, we would describe that good as a normal good. It does what you'd expect. So now the word normal has become a technical economic term, so watch out for that. A normal good is where the quantity demanded increases when there is an increase in consumer incomes. So if you have positive YED, it is important that first and foremost you say the good is normal, it's a normal good. But now, after looking at the sign, you can now look at the size, and this will tell you more, it'll give you more terms that you can add to your explanation. So if you have a number that is less than 1, the good is a necessity or perceived to be a necessity. So if income falls, consumers prioritise spending on these goods as they perceive them as essential to life. So they're fairly unresponsive. YED is inelastic. The percentage change in quantity demanded would be less than the percentage change in income. However, if YED is greater than 1, and the further away from 1, the more extreme it is, it would be a luxury good, or it may be known as a superior good on your course. Here, as income rises, the consumers are already buying the necessities, they were a priority, so any extra income that comes in can now be spent on luxuries. So here, consumers would be more responsive, and you would have elastic YED. The percentage change in quantity demanded would be greater than the percentage change in income. Remember, if you've got this scenario, say a good is normal first, and then go on and add the detail of whether it's a luxury or a necessity. And watch out, there is a little bit of overlap with factors affecting PED. So just reread what you've written. Have you accidentally gone back to your default setting and started talking about price again at this stage? So if YED is negative, the product is an inferior good or perceived to be an inferior good. So perhaps consumers may see supermarket own brand value products as inferior. That may or may not be true. And when incomes go up, they may choose to swap to other better known brands. So an inferior good is simply where the quantity demanded decreases when there is an increase in consumer incomes. We can add a little bit of detail here. So again, if you look at the size of the number, if YED is less than 1, and here, similar to PED, ignore the minus sign. So put the minus sign in brackets and just look at the size of the number. So if YED is less than 1, YED for the good is inelastic. And if YED is greater than 1, YED for the good is elastic. So it's important to be critically alert as an economist and think of the limitations and problems with your initial theory and reasoning. So here's a memory aid of toes to help with that. So let's start with time. So if you have different time scales, say short run versus long run, you could expect to have different responses, and you can reason why. Other factors may have an impact. So all the elasticities are very simplified models. There is only a change of one factor. So what if another factor changed? How would that impact? Watch out with this one though. If you're using these points for evaluation, read the question forensically. If the question had asked something like, examine a factor affecting elasticity, and you've already talked about one factor, and then you go, but it might not be that factor, and you think that's evaluation, it may well not be. Could there be errors? So might the data be unreliable? Is it historical? How long is it since it was collected? May other events have happened that change people's responsiveness, so such as the pandemic recently. What was the sample size? Who collected the data? All sorts of reasons why the data might be biased, so unrepresentative of the market, and mean that you make the wrong predictions. And finally, what's the size of the change in the factor? So responsiveness may depend on this size. You may well get to a point where the change is perceived as so large that the market responds differently to your initial predictions and data. All of these limitations provide problems for your decisions. So if you have predicted very, very precisely based on data, what's the consequence? It could mean that you've made the wrong decision and that scarce resources have been not used as well as they should. So let's recap some of the potential common errors with YED. Let's focus on calculations to begin with. So you are reading the question forensically. You are using the memory aid, you're including workings, and you're checking all the way through. Have you definitely used the original number in your percentage change? Have you possibly swapped around your quantity demanded and your income figures in the formula? Check that very carefully. That's one of the most common errors. Remember the silly memory aids or your own personal silly memory aid. Memorize the method for working out percentage change. Watch out for if the numbers you're given are actually already percentages. Don't multiply too many or too few times by 100. And remember, in your final answer, you don't want to include the percentage there for your coefficient. So make sure there's no percentage in your final answer for YED. So in your words, in your reasoning explanation, be particularly alert to the default setting, and this could apply to the formula as well. So your default setting is PED. So after you've answered a question, reread it. Have you put price in there? Have you gone back to talking about PED theory by accident? And you can easily correct that and still get a fully correct answer. Often as well within this topic, there are words that start to get confused, such as inferior and inelastic, or inferior and necessity. So watch out for those. Be aware of them. Make sure you've checked, have you used the term you intended. And finally, when you come to possibly writing out a definition, be aware it's very easy to merge your memory of the formula and the word definition. So it ends up as if you're reading the responsiveness of a change, which gives you a double change in there, which is not what you want. So watch out for that. So time to have a go at some questions now. You can pause the video, but if you get stuck, restart for some tips, and the answers will follow on the next slide. So here are some tips for question 1. Note the percentage changes have already been calculated. So write out the formula and make sure you can just plug in the numbers straight away. Just make sure you put them the right way round. Here are some tips for question 2. So start with what you know. Have a careful read of the question. Annotate the quantity demanded as original and new. Write out the formula. And you'll see all you need to work out now is the percentage change for quantity demanded. The other percentage change is already worked out for you. So use change over original times 100. Now you're ready to plug in those figures to your YED formula. Just check you've put them the right way round. And here are some tips for question 3. So this is potentially a longer, higher mark question. You might start by thinking, are there any calculations? And it just so happens that these have already been done for you. Sometimes they haven't. So now you're trying to deduce everything you possibly can from the data. And you've got 2 different products there. So if you have 2 different products or regions mentioned, it's always worth doing a bit of comparison. So think what you can tell from these YED numbers and then do a little bit of comparison as well. If you look at the question wording, you can cut it up and you can see the question starts at to examine and ends at shops. And you can cut up the question wording and you can see you've got an end target of relevance for mobile phone shops. So basically you are advising these shops what should they do, where might they make more revenue. Examine suggests an element of critique. So evaluate, match your evaluation to your analysis. So make sure it links back to something you've already said, and do link back to the question for how it's less or not relevant to those mobile phone shops. So have a look through these worked answers for those questions on the last slide. Note the workings are included and the final answers for calculations are underlined to make it clear. Note in the third question the different assessment objectives and the examples that go with them. Try a bit of mark scheme bingo. How many did you get? Are there any that you think you could get next time? Add them to your answer. Hope this video on YED was useful. Thank you for listening.